bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the December 17th, 2024 podcast. Welcome to another episode of our Renewable Energy Tax Credit Finance series with my partner, Tony Grappone. Today, we're going to discuss key topics that you, as a renewable energy developer or investor, should address with your tax accountant or CPA as we approach tax filing season for calendar year taxpayers. Now, Tony and I have identified 10 topics you want to be sure to discuss. We're going to cover 5 of those topics today, and we'll discuss the remaining 5 on the next Tax Credit Tuesday podcast. That podcast will air in 3 weeks on Tuesday, January 7th, 2025. Now, the first 5 topics we'll cover this week primarily relate to the first or second year of a renewable energy partnership. They are the importance of identifying your place in service date, depreciation conventions, the importance of comparing projections to actual results, assessing whether or not you need a DRO, a deficit restoration obligation, as well as considering various state and local tax issues. Now, the 5 topics we'll discuss next episode in January relate to the latter years of a renewable energy partnership. They are determining whether or not you have positive taxable income and the consequences of that, identifying ownership flips, focusing in on the cash flow waterfalls, assessing any tax credit recapture, and monitoring for ownership changes during the year. Now, whether you're new to renewable energy or you're a seasoned veteran, I think it's very important that you tune into both episodes. This will help you have a smoother tax filing season and, much more importantly, help you avoid some financially costly pitfalls and also avoid other unpleasant surprises. I also, as I say every week, encourage you to share this episode with others on your team and any other investors or developers that you work with that you think might find the episode of interest. With that said, if you're ready, let's get started. So Tony, welcome back to Tax Credit Tuesday. This is a record-breaking 21st appearance as a guest on Tax Credit Tuesday.
And counting. 21st
counting.
And counting.
Next year will be 22.
There you go. That's right. So thanks for having me back, Mike. I love doing this podcast and look forward to many more.
So with that 21 appearances or 20 appearances, this being the 21st, any regular listener of the podcast is going to obviously be familiar with your expertise. That said, that there could be 1 or 2 newer to our audience, where this is their first Renewable Energy Tax Credit Finance series podcast that they've listened to. So if you could somewhat briefly share the services you provide to Novogradac clients, I'd appreciate it.
Excellent. Thanks. Yeah, right. So I oversee 3 silos of services here at the firm. Silo 1, I like to refer to those as transaction advisory related services, things like financial modeling and related services. Silo number 2 deals with financial statement audits and other attestation engagements. And Silo 3 deals with really what we're going to talk about today, tax return preparation services. And then within each of those silos, we have professionals that specialize in each one of those discipline areas.
Great. Thank you for that. And as you mentioned, what we are talking about here are tax preparation services, but it's really more about project finance in the sense of the impact that the various issues we're going to discuss have on the economic return to your investor, as well as the economic return to you as a developer. And as I mentioned in the intro, we have 5 key areas that we want to discuss. Now, in preparing for the podcast, as our listeners sort of now know, we had developed this list of 10 topics that we thought were important to share. And as you shared with me when we were preparing for the podcast, these are items that, talk to your team about reaching out to our clients and saying, let's make sure we're discussing these 10 topics with them. Now, in terms of the first topic, I want to jump right in. That is determining the place in service date or dates. Whenever I think of the place and service state, I always default to, real estate and new construction real estate, where the place and service state is generally going to be receipt of a certificate of occupancy. And it has to be a certificate of occupancy that has no conditions on it. I remember years ago, there was a certificate of occupancy that said it was a residential rental property, but you couldn't stay there at night. So the property wasn't placed in service until they had their certificate of occupancy with no condition. Because obviously, if you can't stay there at night, it's really not ready for its intended use. When you're thinking of renewable energy, you obviously don't go to a government agency for the right for someone to occupy the space or rent the space or something. As such, you have to look to other metrics to determine whether or not a particular project is placed in service or facility is placed in service. Please explain to our audience how in the renewable energy space you determine if a facility has been placed in service.
Great. Thanks, Mike. So, right. So with residential real estate, right, taxpayers need a certificate of occupancy. In renewable energy, um, you don't get a certificate of occupancy, but the sort of almost equivalent that you're seeking out is you're seeking from the utility where your facility is located. You're seeking what's called a permission to operate letter, commonly referred to as a PTO letter. So, some utilities refer to it as a witness test letter, which is synonymous with PTO letter. But anyway, each utility has their kind of form letter that they issue to taxpayers, notifying them when the taxpayer is kind of placed in service. Taking a step back from there, kind of similar to residential real estate, a renewable energy facility is considered placed in service when it's ready and available for its intended use, right? And what is the intended use of a renewable energy facility? That is to be able to produce and sell power. Okay. Now, the IRS, what there's also some criteria that the IRS considers when they're evaluating. If the IRS ever audits a taxpayer on the issue of whether or not the facility is placed in service, there's certain criteria that they evaluate. That first criteria is the receipt of what's called required licenses and permits. That's the first criteria. The second criteria is the passage of control of the facility to the ultimate taxpayer. So that'd be going from the EPC to the taxpayer. Criteria 3 is the completion of critical tests. So obviously that's walkthroughs of the facility with the EPC and the utility to make sure that it's operating as intended and in accordance with, local regulatory requirements. Criteria 4 deals with the commencement of regular operations. What we're talking about there is producing power that can be sold based on its intent. And then the last fifth criteria is the synchronization of the facility into a power grid for generating electricity to produce income. Now, those are 5 criteria that the IRS considers. You don't have to meet all 5 criteria, and there isn't one criteria that's considered the holy grail of sorts, but those are the 5 criteria that the IRS is apt to consider when they're evaluating whether or not a taxpayer has placed their facility in service.
And this is a layup question. What's the importance of the place and service state to our listeners and viewers?
Exactly. So, this is such a timely question and podcast, right? Because end of the tax year is when facilities are being placed in service. You can't report tax credits until your facility is placed in service. So if you haven't met that important criteria, you're not able to put those tax credits on your tax return and allocate them off to your parties or to sell them off to your transferee.
Now, and that's important. And with historics and renewables, you claim the credits when you place in service. Local zinc tax credits, you actually only claim credits for the portion of the year you've actually been leasing a place in service property to tenants. So they are slight differences across various tax credits. So let's move to our second topic, and that has to do with tax depreciation conventions. So who doesn't like a convention? But that's not the conventions you're talking about here. So please highlight for our audience the most common options, because there are options with respect to tax depreciation and some of their reporting implications.
Exactly. So the IRS has different conventions that they allow taxpayers to depreciate their assets over. And so the most common convention that you see for renewable energy facilities is called MACRS, or Modified Accelerated Cost Recovery System. And MACRS if we're talking just I'll just use solar as an easy example here. If you look at a solar facility, typically substantially all of the solar assets are depreciated using makers. And most of those assets qualify for 5-year makers depreciation. So that's considered accelerated depreciation. And then even within makers, you've got the option, you've got bonus depreciation that can be claimed. And bonus isn't extra depreciation. Bonus is just even more accelerated, where you get to write off a significant portion of your basis in the year you place the facility in service. And the portion that you don't expense via bonus, then you depreciate using standard kind of makers can, lives and depreciation rates, et cetera. Now, because makers provides for this very accelerated depreciation track, that can really increase the taxable losses in those early years. When you have such significant tax losses, that can be good for an from an IRR perspective for an investor, because an investor's IRR sort of gets enhanced as they get quicker tax depreciation loss deductions allocated to them. However, that can create capital account issues for a partner that they need to be sensitive to. And so if you're an investor, although generally speaking, you like the idea of faster depreciation deductions, if that creates sort of a unfavorable capital account profile for you, well, then you might actually be better off using a different convention, which is referred to as alternative depreciation system, or simply referred to as ADS. And under ADS, the assets that you would normally depreciate under makers over, say, 5 years, you'd be now depreciating over, say, 12 years under ADS. And so that depreciation profile under ADS is going to be much lower. Your IRR is probably going to be negatively impacted as a result. However, your capital account in the partnership will be preserved over a longer period of time, and that might, provide a better overall outcome for you as you sort of look at your overall sort of tax goals and objectives.
Great. Thank you for that. And as a bit of a history lesson to our listeners and viewers, you might be thinking, why is it called modified accelerated cost recovery system? And that's because there used to be acres, the accelerated cost recovery system, and that system was modified to become makers. And it was a little bit more rapid under acres, and then makers was a little bit less rapid. So our discussion of place in service date or dates, as well as tax depreciation conventions, topics 1 and 2, provide a good segue into our third topic. And that has to do with comparing the financial projections that were shared with the investor, that developer prepared and or the investor prepared, and they both negotiated their arrangement based upon those projections, comparing those to what has happened to date. And I mentioned it's a good segue because one of the first things you want to do as a developer, as well as the sort of tax preparers, to get those financial projections and say, well, when was it estimated to place in service? And what were the estimated depreciation conventions that are going to be adopted as part of the negotiations with the investors, so they knew what benefits they were expected to receive and when. It's also something we talk a lot about on the podcast across all the various tax incentives we work on and work with, because we want to make sure that you have these financial projections at the beginning and then you're monitoring them over time. So if you could share, some of the things that you look at, Tony, when you're comparing the original financial projections to what has happened to date.
Right. Yeah. So the projections are a very important analytical tool to look at as you're doing your year-end tax planning, or as you start to prepare your tax return, especially year one, right? And so, because it's that first tax return that you file for the taxpayer where you're going to elect these depreciation conventions, okay? And you want to make sure you sort of reflect the intent of the parties, and that intent, as you mentioned, is reflected in those projections. And so, a common mistake you can sometimes see is, because makers and bonus depreciation are thought to enhance, that it sort of like drives tax losses earlier on. So a lot of people just naturally assume, who wouldn't want bonus depreciation? It creates a higher tax benefit. Of course, the investor is going to want more tax deductions sooner than later. Okay. And so sometimes you can see a client and a tax return preparer if they forget to look at the projections, they might just innocently assume that the investor is going to want bonus depreciation. You really want to go and look at those projections and see what the model reflected. Because if the investor cared more about their capital account being preserved, okay, and making sure the capital account doesn't go negative too early on in the partnership's life cycle, they may have wanted ADS. They may have wanted a 12-year straight line depreciation profile. And so you'll figure that out if you look at the projections. And so I always tell my team, when you're going to prepare the tax return that first year, make sure you are looking at the projections. Look at what the estimated tax credits were. Look at what the estimated place in service dates were. Look at the depreciation conventions. Look at the NOI profile, capital account contributions, etc. So you can looking at that projection while you prepare the tax return can sort of help mitigate the risk of unintended mistakes. Um,
No, that's great. There's so many yeah, questions that can arise when you're looking at the actual versus projected. And one of the items that you mentioned, you went through a number of different sort of items. One of the ones that you mentioned was looking at the capital account. And that in and of itself is a transition to our next topic, which is a bit more technical, but something that every renewable energy investor and developer, should have at least a working knowledge of. You don't have to have a technical regulations understanding of capital account maintenance and the like, but you do need to have a working knowledge, conversational knowledge. And that has to do with the concept of a deficit restoration obligation and whether or not the investor needs to have a deficit restoration obligation in order to be allocated the credits that the investor is expecting to be allocated. So, Tony, if you could explain what a deficit restoration obligation or DRO is, and maybe even back a little bit in terms of the whole concept of capital account maintenance rules, and then explain when a deficit restoration obligation may be needed.
sure. Okay. So if you're a partner in a partnership, generally speaking, your capital account cannot go below zero. However, there are certain circumstances when your capital account can go below net zero. One of those is when you've agreed to restore your capital account. Okay, so meaning if your capital account does go negative, you agree to a deficit restoration obligation where you agree to restore your capital account up to at least zero no later than immediately before you exit the partnership. Okay? And if you have that deficit restoration obligation in place, then your capital account is allowed to go negative up to that DRO limit. Okay? Now, why is this important? Now again, I'm going to talk about a scenario involving a solar facility. Solar energy tax credits are required to be allocated to the partners in accordance with each partner's profits interest in the partnership. Okay. Now, well, I'll talk about this in the context of a partnership flip arrangement. So if your tax equity investor has, say, a very typical 99% pre-flipped profits interest, well, then the intent is that investor is going to get allocated 99% of the tax credits. Well, they are also going to need to be allocated 99% of the profits of the partnership. Okay. And most tax advisors agree that in year one, when the partnership generates that tax loss, as a reflection of profits should also be allocated 99% to that partner, to that investor partner. Now, it can be difficult to allocate that, or you can't allocate that investor 99% of the losses if they don't have sufficient capital account to withstand the loss allocation. Okay. Now, let me just paint a picture here a bit. Let's imagine you've got an investor that put in their first and or second capital contributions. And very common in renewable energy, a tax equity investor usually makes the most common installment schedule in the marketplace usually involves 3 capital contribution installments. And a common installment profile is where the investor has, up to 20 to 25% of their total capital commitment contributed no later than when the facility is placed in service. And then their third and final installment, oftentimes somewhere in that sort of 75 to 80% of their total commitment comes in post placed in service. Okay. So you can imagine now that a facility gets placed in service late in the year, say December. The investor hasn't yet put their third and final installment in before year end. So they've got 25-ish% of their commitment invested in the deal. That the amount of capital that they've got invested at that point, that may not be even be enough to cover the ITC basis reduction. Okay, so without getting too bogged down in the weeds of all the various tax attributes, but I think most of our listeners are aware that with an ITC property, an investor has to reduce their capital account by half of the investment tax credits that's allocated to them. So there you can have a scenario where the investor's only funded 25-ish% of their commitment. They have an ITC basis reduction that's reduced their capital account, maybe even to a point where it's already negative. So, and on top of that, the partnership's generating a year one tax loss, increased by the accelerated depreciation. And now you need to allocate 99% of that tax loss to the investor, and yet they don't have enough capital account to be allocated the loss. So what do the parties do to sort of cure this issue? A lot of times in that year, especially in year one, you'll see the investor go to the partnership and say, look, we don't have, we may not make it's possible we don't make our final installment before year end. So what we want to do is we want to enter into a deficit restoration obligation agreement to help provide the necessary tax support so that the partnership can allocate us that year one loss to support and the DRO will support that negative capital account in that case.
Right. Thank you for that.
A
I
lot.
would just to add to that as a further clarification, that's usually a limited DRO, as you know. So when you're talking about a DRO, it'll be limited to the amount, kind of some number that you think will be sufficient to cover your deficit capital account. And when you think of deficit restoration obligation, it's your obligation to restore the deficit in your capital account. And generally, when the DROs are put in place, an investor won't have an unlimited DRO. It'll generally be there'll be some limitations to the DRO because you never know what could happen that would cause you not to make the next capital contribution, ultimately ending up, there is a risk of having to fund it in a circumstance where you'd prefer not to. And I always find it interesting, Tony, that for investment tax credits, so for, solar ITC, it also applies to historics, that the credit itself is allocated based on profits. And every other credit is allocated based upon the allocation of the expense that generates the credit or the expenditure that generates a credit. So LIHTC, for example, is allocated based upon the depreciation that locally taxable properties generate. And the fact that ITC is based on profits goes way back to an IRS ruling that then made its way into Treasury regulations and the like. And I've always found it interesting that it's continued to be that way because it's so inconsistent with all other tax credits. But we won't unpack that on this episode.
Right. Great. I appreciate you mentioning the limit to the DRO. Okay. Because in my response, I didn't talk about how that DRO is usually sized, especially in that year one. So just to kind of add a little bit more color there. So in terms of the sizing of that limitation, the way investors oftentimes will size that limitation is they'll size it to that third and final installment amount, because that third and final installment amount is usually more than the amount that they need to be allocated that year one loss and to cover that ITC basis reduction. And I too I actually really like the way the loss allocation rules are written for the low income housing tax credit program. Easier to understand, easier to explain to clients, apply. So yeah, I can relate to you there on that front.
No, it's definitely easier to understand. And when you mention easier to apply, in some levels, I think you're referencing, or at least one of the things you're referencing is the fact that when you look at the profits interest in years where you have net losses, to what extent, is it your theoretical profits interest? Is what you ultimately end up getting in terms of profit shares and all the rest? And once again, we're not going to unpack that here.
Right.
Because that's already been agreed. There's an arrangement and understanding at this point in the life cycle of a development and you really, all that was worked into your projections.
Right.
Anything else
That's
you
why,
wanted to,
yeah.
go ahead?
Yeah, yeah, just more to that point, just to kind of, hammer it home a little bit more. That's why in my initial response, I was saying like most tax advisors agree that year one loss is sort of almost akin to profits or synonymous with profits for that exercise. And I think we'd all sort of appreciate it if that uh, tax guidance was maybe even just a little bit clearer there. So you didn't have to make that interpretation that the loss is sort of akin to profits.
Right. Now that's an excellent point because technically the credits don't follow the loss allocation, but you wouldn't want to be getting less than 99% of the losses.
Exactly. That's right.
Anything else you wanted to say on DROs before we jump to our fifth topic?
Yeah, that can be some dense material to sort of absorb. So obviously reach out to us if that wasn't quite clear and you want a further explanation.
So the fifth and final topic relates to state and local tax issues. Everything we've talked about so far, kind of implicit, is that these are federal income tax issues. And oftentimes the state income tax will just adopt federal, and state laws generally, if there is a state income tax, generally they'll either automatically comply to federal law by default. So when federal law changes, state law by default is changing as well, at least the start of state law. Others will adopt federal changes sort of after the fact. And it's always whenever we're seeing tax changes, well, obviously next year we expect to see some major tax changes. And there'll be some states where when the federal tax law changes, the beginning point of your state income tax will be based upon the new federal law, whereas other states will have to adopt those changes. And then oftentimes states will selectively adopt some versus others. Uh, but when you're dealing with the first year, second year of a renewable energy project, you have to be looking not just at federal, you'll also be filing in various states, as well as potentially having local tax obligations. So this podcast isn't about only state and local tax issues. Maybe we should have you back as part of this series, have a state and local tax issues podcast where we focus on that as part of the renewable energy tax credit finance series. But if you could right now just share a few of the issues you would want to bring to the attention of renewable energy developers and investors as we approach tax filing season for calendar year taxpayers.
Excellent. Yeah, great. Thanks. So yeah, for state and local tax purposes, I'll just refer to it simply as SALT. Um, you definitely want to be aware that there can be differences between your state and local state taxable income and your federal taxable income. A couple of big examples to really highlight. One, tax credit transfer proceeds. We're in this sort of like IRA world where so many taxpayers are now transferring or selling their tax credits. We know that for federal income tax purposes, tax credit transfer proceeds are tax exempt. That may not be the case in every state. Okay, so you want to, whatever state you're located in, you want to take a look and see how does the state treat tax credit transfer proceeds. And I'll give a plug to my partner Tom Bowman and his colleague Reza Kareem, who Reza's done a lot of great research and work on the tax credit transfer treatment across the various states that are active in renewable energy. So if you have questions in terms of how the tax credit transfer proceeds are treated in the state that your facility is located in, reach out to me, reach out to Tom Bowman, reach out to Reza Kareem, and they can definitely help you out there. That's a big one. That's a big one because it's such a new hot topic. I definitely want to stress that. Another common one is with respect to bonus depreciation or just makers depreciation or depreciation in general. Not every state mimics the federal rules with respect to depreciation. One common error we find is it's not even an error, it's really just a misunderstanding, I should say, is where our clients assume that the same amount of depreciation they're getting on their federal tax return is going to show up on their state tax return. A lot of states don't follow the feds in terms of depreciation calculations. So you have a lot of add backs. So you'll have this big depreciation number on your federal return. Then you go to the state tax return and you have this what I'll call an add back where they'll kind of add back income with respect to the depreciation element that was claimed on the federal tax return. Uh, Basically meaning you don't have as much of a state tax loss. You might even have state taxable income in some cases. And so, again, if you've got questions in terms of how the state tax depreciation rules work, reach out to me or others here at the firm to kind of run that analysis. I'll also point out that when we prepare financial projections for clients, those models are almost always prepared assuming prepared on the federal income tax basis method of accounting. We only run those models on the state income tax basis method of accounting when a client specifically makes that request. Otherwise, the assumption is the model is prepared only on the federal income tax basis method. It doesn't show that sort of state and local income tax profile, again, unless separately engaged and requested.
Thank you for that. One other question that I have is, what can you say about like gross receipts taxes
Gross,
at the
okay,
local level?
right. So different jurisdictions impose certain gross receipts tax. California is known for this. I believe even Texas is known for a gross receipts tax. I don't know all the
Yeah.
jurisdictions off the top of my head, but right. And how that works is, they're taxing the gross receipts or gross sales. So your total electricity sales and that kind of thing. And so yeah. Again, a bit of a big plug here for Reza Kareem,
Yeah.
because he does a lot of work for renewable energy clients on a variety of state and local matters, and he can be just a wealth of knowledge to kind of tap into here.
No, thank you for that. And that's the whole gross receipts taxes is something that, you want to try to identify in the context of your projections, because that'll be a kind of a cash flow cost. And it's just something that can pop up unexpectedly in different areas. And it can be a little bit harder to track based on all the jurisdictions in the nation and such, but it's something for the viewers and listeners to be mindful of. And I will say that if this is to our listeners and viewers speaking to you, if you think it would be good to have Risa on to discuss renewable energy and state and local tax considerations, a lot of various traps for the unwary, please just send an email to CPAs at Novogradac.com or leave a message other places, or you can tweet at Novogradac that you think that'd be a good podcast to have, and we'll get that scheduled for sometime next year. So I do want to recap the 5 areas we've discussed today. First, we discussed determining the place and service date. That's something that you want to be discussing with your tax CPA as you approach the tax filing season. Also, be sure to discuss the tax depreciation conventions that you want to adopt. And in assessing your place and service date and the tax depreciation conventions, be sure to look at your financial model to see what you are projecting for your investor. I always like to say the one thing you know for sure about a financial projection is it won't happen the way that you project it. And hopefully it's really close, but that's also a double check. So number 3 we talked about was the financial projections. I will also say that if you're a large organization and multiple teams and you have some in the development phase, some in the operations phase, and the rest, make sure that the feedback as you identify what actually happened relative to the projection is going back to your development group. So you can constantly be assessing how to make your financial projections for the next facility more accurate. Number 4, we talked about the hyper-technical, whether or not you need a deficit restoration obligation, or more accurately, a limited deficit restoration obligation or not. And then 5th, of course, we just talked about state and local tax considerations. With all of that said, Tony, I think this was a great way to close out Tax Credit Tuesday for 2024. And I like the fact that you're bookending the end of 2024 and the beginning of 2025. To remind our audience, we'll be back on Tuesday, January 7th, 2025. We'll have part 2 of this discussion where we'll complete our top 10 list, if you will, with the next set of 5. And with that, Tony, thank you for being on the podcast. And
Thank
for
you,
this, it's always great to have you. And I'll look forward to having you as the first guest of 2025. And to our audience, I'm Mike Novogradac. Thanks for listening, and we'll see you next year.
This weekly podcast has been brought to you by Novogradac & Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac & Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.